What's up? What's up, everybody? Welcome to the Bubba Broadcasting Network and welcome to Mr. Navicka's investing class. I am so happy that you all chose to come to this class because I think you'll find it will help you in your future as you become young adults and move into your investing and even protecting your own portfolios as you become older. Or some of you may indeed want to become full-time traders and be a part of the investment community. So I think this class will go a long way in helping you to understand the investing world much better, which after this class, you'll have more knowledge than 95% of the investing public does going forward. And we can believe and are more heavily involved in the option world, although we teach the entire investment world and how to run from stocks and bonds and everything. The biggest focus here is options because options are the most misunderstood product. Now, I've been doing this for over 35 years, and many of you know me. I'm Todd Horowitz, better known as Bubba throughout the investing community. I do a lot of trading myself and have done so for over 35 years, as well as appear on Fox Business every Wednesday after the bell, CNBC every Friday morning, and Bloomberg every Monday. Plus, I also do have my own radio show. So what we're going to do is we're going to talk about investing. And today I thought we would just take, what the basics of options are and what we're looking for. And options are what we call a derivative product, which means that they're derived from something else. Now, many people in the real estate market, for example, people they rent a house with an option to buy. And what that means is that the buyer and the seller secure a price amount and how much of that payment will get put towards actually buying the house, and they put a date on it. In other words, they put an expiration date on it. So if you wanted to buy a house at $100,000 and you were going to pay $1,000 a month rent, you and the options writer or the underwriter, the person selling, would say, okay, we're going to apply X amount of your payment towards the principal of the house, and I will guarantee this house for 1 year at $100,000. Now, 1 year passes, and the house is only worth $80,000. Well, so I guess the question would be, would you exercise your option or your right to buy that house at $100,000? The answer would be probably not. You would probably walk away or renegotiate it. Stock and equity options work the same exact way. Now, you can either be a buyer of an option or a seller. A seller is called a writer because when you're a seller of options, you are becoming more of an insurance salesman. You are selling insurance against a certain event occurring. But when you buy options, that's what we're going to focus on today, is buying options. You're buying a right to do something at a certain time at a certain price. And we're looking at a chart right here of the Dow Jones Industrial Average. And of course, we can look at different time frames of this chart, and we can look at what's going on in the overall market. And we can kind of see that if we look at for example, if we look over the last year, we see a chart that consistently has gone up for the past year. And of course, if you follow the markets at all, we know that the stock market is at all-time highs and continues to go on an uptrend. So if we were looking to buy an option in the Dow Jones Industrial Average, we would probably be looking to buy a call option, which means a call option is the right to call away stock, or in our housing example, the right to call away the house, which means that you want the value to increase and you can buy an option on that right, on that value. So if we thought that the Dow Jones Industrial Average was going to go to 17,400, we could buy a right to purchase that at 17,400 at a very cheap rate right now, but we are paying a premium. You are paying more than the value of the right, but what you're buying is you're buying time. And it's important to understand because when you look at the option model itself, every stock that we look at has different vehicles and different reasons and why it goes up. Now, I know many of you are familiar with Apple, and we're going to just look at a chart of Apple. And many of us have Apple iPhones or that type of technology. And if we look at Apple, it's very similar. It was if you've learned this in class, it was first in a big consolidation period for months, and then all of a sudden it broke out and it went higher and is now in a solid uptrend. Now, if we thought back when the stock was trading at 80 that it could go to 85, we could have bought the right to purchase that stock by buying a call option, which again gives us the right to buy that stock at 85 at a certain time at a certain date. So right now we look at Apple and it's trading at $100 a share. You can see the close here was 100.96. So if we look at the options chain or the option model, okay, here we're looking at an option change and there are many different strike prices in here. What is the strike price? The strike price is the price at which you decide that you think that Apple can go to. Now, typically you will learn in class that we're going to trade most of our options around the money or at the money. So the at the money option right now would be about the 100 strike. So if we thought Apple was going to go higher, we could actually buy the 100 strike right here. So right now the market or the bid and the ask on the 100 strike is $3 bid, $3.15 offer. What does that mean? A bid and an offer, the buyers are willing to pay $3, the sellers are willing to sell it at $3.15. Okay, now either we as a buyer can reach up and pay $3.15, we can bid $3.05, $3.10, we can try to work somewhere in the middle. At some point, what's going to happen is we're going to do what we call discover price, and we're going to be able to make a trade. Now remember, for every trade, there has to be a buyer and a seller. However, just remember this, when the markets are going higher, that means that the buyers are being more aggressive. When the markets are going lower, it means the sellers are being more aggressive. But at the end of the day, every buyer has to be met by a seller. So we talk about, it's called price discovery of the option. But there are a lot of things that are tied into the option world, and that is the first thing we look at is the price. The second thing we want to talk about is liquidity. And what is liquidity? Well, you know, everybody looks at certain stocks and they see how much volume and how much action that they get. But at the end, even though it may trade a lot and it may have a lot of action, it may not be liquid enough for us, a trader, to trade and make money, because there are trades that are only good for what we call professional traders or market makers, which I am one of them, and spend time on the floor. And then there's a trade for us who trade off a computer, the retail trader. So when we look back and we go, you know, one of the examples I like to use and share with everybody, and the mindset that you want to start to think about is, if I asked you about a company, and we'll say, let's say Coca-Cola, okay? We all, at some point in our life, I know many of you in today's younger generation don't drink Coke or Pop or Pepsi or whatever that anymore, but we've all heard the brand name of Coke. And if you think about Coca-Cola, do you think, if I said to you, what is the likelihood of Coca-Cola making a major announcement in the next 12 months that would have a major effect on their stock price, what would your answer be? I'll let you think about it for a minute, because I can see the guy there in the far right falling asleep, but don't do that, because this is important stuff and you'll enjoy it, okay? And when you understand it, it will be a lot of fun, because this is a game. The option model is a game just like any other game you may play. It all has to do with odds and probabilities of an event occurring. Okay, so the answer is Coca-Cola most likely will do nothing in the next year based on news. Why? Because it's a big, well-capitalized company. that has very little risk, and there's very little bit that can phase the company. So if we look at the options model of Coke and we go back to the stock is trading at 42.05. If we look at the 42 option in October, it's trading at 64 cents. Okay. Now, what does that mean? Well, the 64 cents is the amount that the market makers feel is a fair price for where Coca-Cola can trade it. So if you're thinking of like an insurance policy, this is a fair price that you can either buy or sell and take an opportunity to make money. But the key that moves options is what we call implied volatility. And if you can see this number here, 13.60, which is a very small number when it comes to volatility. And really, if you think about it, think about a balloon with air going in and going out. Well, the Coca-Cola balloon has very little air, and we know that it's got very little chance to make any major movement. Hence the reason that the options are only trading at 64 cents, which is why you can buy the right to buy Coca-Cola at $42 in October, which is 26 days from now, for 64 cents. Now, we look at another stock that is similarly priced to Coca-Cola, and let's look at DDD. Okay, Delta. That's the 3D printing company. Okay, now, if I ask you the same question here, what is the likelihood of them having a major announcement or a major move in the next year? Of course, if you don't know about DDD, it's a new product. It's 3D printing. The odds are fairly high and likely that there's going to be a big move. And if we look at it, we can see, if we go to the same scenario, we look at the at-the-money option, which would be the 49. And sure enough, the 49 call is trading at $1.76. So why is it worth 3 times as much as Coca-Cola? Well, if we look at the air in the balloon or the implied volatility is also almost 3 times as much. So when we look at this, these are things that we learn to understand, and you won't get it in one time here. But what you want to understand is this is what affects the market. Now, just because one is 13 and one is 32 doesn't make one better than the other. But I can tell you that when you get to the lower ones, the Coca-Colas, Bank Americas, and those types of companies, they are not going to move so much. And how do we know? Well, if we go back and we look at history, now here's a chart in Coca-Cola. Over the last 12 months, the stock has only traded in a $6 range from the bottom here, okay, to the top here. And one of the exercises I like to do, forget about the option right now, but if you traded the stock and you traded it 100% perfectly and you bought it when it was 36 and you sold it when it was 41, you'd have made $5. If you sold it short at 41 and bought it back at 37, you'd have made another $4. So you're up $9. If you'd have bought it at 37 and sold it at 41 again, you're up $13. And then you could have made maybe another $3. So you'd have made $16 in 1 year if you would have traded this absolutely 100% perfectly. Now, if we look at Bank of America, we will see a very similar BAC, Bravo, Alpha, Charlie. We'll see the same kind of action. Okay, doesn't go anywhere. 13 to 18, back to 14, back to 16. There is no action here. This is not liquid for us. So if we look at our stock DDD, okay, we can see that it went from 50 to 90. So that's $40 alone. Came back from 90 to 50. It's another $40. Went back to 80, down to 40, back to 70. So if we look at all these spots in the same time period, that in Bank of America or Coca-Cola, we could have made $12 or $13. In any one trade on DDD, we could have made $30 or $40. So which, in your mind, gives you the best opportunity to make money? And in my opinion, the more air in the balloon, the more volatility you can get, the better off you are. So our objective is to find out at which point these options give us an opportunity. So I have a couple of trades in mind that I would like to look at, and one that I like a lot is LNG, Lima November Golf. Now, when we're doing technical analysis, we don't care what the companies do. We only care what the chart tells us they're going to do. because everything is built into the chart. So if we look at LNG,